A 1.2 million farm, a missed tax condition and a €700,000 gift tax bill, well, it's easy to happen if you don't know what you're doing. And unfortunately, this happened to a farming family who hired an accountant to restructure their business and implement estate planning. The case involved the restructuring of a large farm into a limited company as part of a family succession. Now, ultimately, the assets were passed on to the next generation, but just 13 months after the restructure took place. As you probably know, agricultural relief is key to eliminating or reducing gift or inheritance tax when passing farmland to the next generation. But there are many conditions to be satisfied to access that relief. One is that the assets must be held by the disponer, the person making the gift or inheritance, by at least 2 years before the transfer. Now, in this case, the condition was overlooked when the estate planning and the restructuring was implemented. As a result, when Revenue examined everything, they denied relief, triggering a gift tax charge of over €700,000. Now, most families just don't realise how many strict conditions apply, not just for agricultural relief, but for business relief and retirement relief. All reliefs that are critical to estate planning. And this is why professional advice from a tax expert is essential, and not simply from a solicitor or accountant. If a transaction involves moving assets from one generation to the other, expert tax planning advice is essential. For guidance on how to structure a farm transfer correctly and avoid this type of problem, you can book a consultation with us via the link in my bio or online at taxunwrapped.ie.